Howdy, Jacob here. Today we're looking at Beazer Homes in the household durables industry. 841 million market cap on 1.7 billion enterprise value. It's an under 1 billion market cap company with 6.4% insider ownership. It's really not bad for really small companies. Prefer 10% or above, but again, everything's just a number. It creates a story for you. Nothing to be taken as black and white. There's gray area in everything. So really not bad insider ownership. Founded in 1985, headquartered in Atlanta. It's Atlanta. Okay. Growth has been fairly impressive, actually. It's slowed down quite a bit. It's been lagging for the last 5 years, but the 5 years prior had 10% growth a year for the 5 years. But again, if we take the most recent years, we're gonna have to see, why that changed a bit. I mean, because it was pre-COVID where revenue kind of stopped, margins got hit a bit, so we'll have to dig more into that. Operating margins, mid upper single digits. Gross margin 20% recently. Mid double digits in the past, or mid teens in the past. Balance sheet shows 346 million cash on hand with just about a billion long term debt. So that $1 billion long term debt compared to their free cash flow is, so this is going to be their capital expenditures. For some reason that didn't pull through, but let's say 150 million. So 150 million, that's going to be 6 to 7 times that 5 year average free cash flow. It's not a terrible concern, but I mean it's a lot more than I would like. So that means that I would presume this company is going to likely put in about 50% of capital allocation towards debt reduction to get that to a much more tamed 3 times roughly free cash flow. And so for me, that just leaves 50 million, $75 million to really grow the business, to give you money back as a shareholder outside of debt reduction. So I mean, we might as well just get ready to make some assumptions here. So on the growth side, I mean, it's been very lackluster. I would probably just say pretty much inflation. Terminal PE a bit below market average. For margins, maybe let's do 6, 5. Share change, haven't bought back any shares, but about 8 million stock-based compensation, and that's about 1% increase. So with my assumptions here, this is assuming about 50% capital allocation to debt, 50% towards reinvesting, making acquisitions, just growing the business or making margins better by efficientizing, making the company more efficient. And we're saying the stock price needs to fall 35%. With these little growth companies, you really want share repurchases. Like, I think share repurchases are going to be the best form of reinvestment for a lot of companies that can't grow. It's going to increase their earnings per share without really actually earnings growing or margins increasing. But here, I mean, if they do make acquisitions or reinvestments that are advantageous, they've had a historical return on invested capital that has been good in some years. So, I mean, it's just these type of companies I'd want to get really cheap is what I'm trying to say. So I do hope you enjoy the video, though, and have a great day. Thank you.